Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. As anybody that's ever heard me open my mouth ever in my entire adult life should know, I love Brookfield Infrastructure. It is one of my favorite stocks. It's been an absolute market crusher over the past 15 years, and it's one of the largest stocks in my portfolio. However, my good friend Tyler Crow is starting to have some serious concerns about one of my favorite stocks. Now, the question is, who is right? We are going to have this conversation because whether Tyler is right or not, one thing I have learned as an investor is you always have to find the things that challenge your bull theses about the stocks that you own. So Tyler Crow, you are my bear. How's it going, buddy?
I might be your slightly unhinged bear. Am I your cocaine bear? Am I your crazy guy that's just going to come in and do something really weird?
Tyler, cocaine bear Crow. We'll go with that. But yeah, I do. I feel like I was teasing you, and I feel like a little bit it's like the meme from It's Always Sunny in Philadelphia.
The Pepe Sylvia meme where he's just pulling a bunch of strings together for absolutely no reason whatsoever.
As conspiracy theory as it gets. But again, I want to circle back to it and say it again. It's really important as an investor because if you look at the market, the history of the market, the performance of the entire cohort of public stocks, there are more bad stocks than good stocks. That's just the math. And that means that the odds are that you're going to pick a bad one. Even if it's one that's been a big winner in the past, there's no guarantees it's going to continue to be a winner. So what are you seeing right now that has you concerned with Brookfield Infrastructure?
So this is where it starts to get a little bit of weird for me. It's from 2017 through 2021. Brookfield Infrastructure went on quite a bit of an acquisition spree. And as a result, when you buy assets from somebody else, you're typically paying a premium, and you start building up things like intangible assets, goodwill, things like that, right? Right now, this is a hard asset business, but 27% of its entire assets on the books are intangible assets. So I'm starting to wonder, when you're making that many acquisitions in an extremely low interest rate environment, is there any concern that some of that could be written down? Could that impact the profitability of or how they projected it when refinancing does need to happen? Now, granted, it is a company that probably is still going to have good access to capital. For a company that prides itself on a lot of asset recycling, we're going to sell assets because we don't see as much growth and we can go invest in other things. In a very high rate environment, capital recycling is less lucrative. And so you start to throw in those sort of things, and it makes that capital recycling engine not what it used to be. You start looking at other things too. In the past 7 years or so, it's gone from having a positive tangible book value per share entity until now it's book value per share tangible is negative $33.25 because of things like intangible assets when you're making acquisitions, bringing on debt, and what have you. So you start doing this and look at again all these things, and you have to say, okay, but funds from operations per share, which is what management reports, is still going up. Am I still okay with that? Do I believe enough in management that what they're saying with these funds from operations metrics, which technically are GAAP metrics, are those still satisfactory to me? Or do I really want to start looking at the GAAP numbers and say, now it's starting to look a little weird?
So hearing everything you said and thinking through it, just to distill it down, this isn't a conspiracy theory of concern about hidden assets or bogus things on the book or high level of complexity, which is something we've talked about with Brookfield Asset Management, for example, in the past, is how opaque it can be to really know what's inside the books. The concern here is, again, just the basic economics of the price that it paid for the asset. So you look at its goodwill on its books. It's about $9 billion of goodwill, which is less than half of all of its intangible assets on its books, right? So you think about what it paid for those assets. And again, in this rising interest rate environment, its ability to use what had been a proven strategy in a falling interest rate environment is far less likely to be as effective at generating cash returns, the kind of return profile that it's generated in the past, and concerns that's going to weigh on its ability to generate the kind of cash flow growth, the kind of operating growth that it's generated in the past going forward. Am I hearing you right?
More or less, yeah. Yeah, I think that's where I want to get at. And like you said, $9 billion in goodwill. This is only a $16 billion company, or at least from a market cap perspective. That's not an insignificant amount of goodwill when you're talking about a business of this size, despite it saying it has $72 billion in assets. It's still only a $16 billion market cap company. I think that's the argument on whether or not you want to hold it. Certainly, buying it right now does not look attractive in any way. Right now, it has a dividend yield in the 4.2% range, 4.3%, which historically speaking is actually quite low.
Yeah, that's the thing. That sounds. You hear that and you say, hey, that's actually pretty good if you're comparing it to Coca-Cola, et cetera, and a lot of those blue chips. But that's exactly the point. If you look at it, compare it against its own historical average, in an environment where interest rates were far lower than they are today, this is one of the lowest yield periods that it's had. The past couple of years is the lowest yield period that it's had in the past 10.
Yeah. So I think I've landed on this. I'm certainly not wanting to add new capital to any position in Brookfield Infrastructure. I should mention I am a shareholder. Mm-hmm. So it's not like I'm coming at this from I hate this company, I want to short it. This is me going through my portfolio and having real questions. And so certainly I don't want to be adding capital at what we were just saying, this kind of historically low yield time in a high interest rate environment. But some of those concerns on acquisitions that were made, the timing, refinancing, all of those things does have me concerned that we could be headed for a period of lower returns than we have come to expect from Brookfield. That, I don't know. I do want to keep an eye on it.
So taking all of that together, Tyler, it's really interesting because I will tell you that you and I have actually reached the exact same conclusion, and somewhat for similar reasons. Number one, my concern about this rising interest rate environment affecting its ability just to acquire, right, and generate the kind of returns based on higher cost of capital. You're talking about its ability to sell existing assets, to use those to redeploy to higher growth assets, which has been its model. So taking that same thing, like the two different sides of the coin that we both agree on, and combining that with the one thing that we were both talking about, that this is an absolute conclusion that I've had. I'm not selling a single share of this business, but I'm not buying a single new share right now because I do think that the valuation that it's trading for and those risks of being able to generate the same kind of returns with new capital deployed could be hindered. Where I stand on it is I'm going to watch them deploy capital and try to reach some conclusions about how have things changed, how has the environment changed, and also observing how is the market valuing the stock, and then maybe make some decisions.